welcome back to Boni's Life, your home for the most in-depth and unfiltered analysis of the crypto universe. Today is January 27th, 2026, and the market is a battlefield of conflicting signals, a chess match between fear and opportunity. While mainstream headlines are painting a picture of stagnation, we're going to dig deeper. We'll dissect the past 24 hours, uncover the hidden narratives moving the market, and give you the strategic insights you won't find anywhere else. We'll explore the seismic shifts in capital flow, the geopolitical tremors shaking the foundations of the global economy, and the technical tripwires that could dictate the next 24 hours. By the end of this episode, you'll have a clearer understanding of not just what happened, but why it happened and what you can do about it. So, grab your coffee, get comfortable, and let's get into it. The global crypto market cap is currently sitting at a staggering $3.09 trillion, a modest 1.2% increase over the last 24 hours. The 24-hour trading volume is around $113.64 billion, which is actually down significantly from previous sessions, telling us that while the market is holding its ground, there's a sense of hesitation among traders. This declining volume is a critical signal that we need to pay attention to. In healthy bull markets, we typically see rising prices accompanied by rising volume. When prices stabilize but volume drops, it often indicates that participants are stepping back, waiting for a clearer signal before committing capital. Bitcoin's dominance has seen a slight dip, now at 57.3%, while Ethereum holds 11.6%. This suggests that some capital is tentatively flowing into altcoins, but it's not a full-blown alt season just yet. The CoinGlass Fear and Greed Index is currently at 30, firmly in the fear territory. This is a contrarian indicator I love to watch. When the market is fearful, it can often be the best time to look for opportunities. But fear doesn't exist in a vacuum, so let's break down the factors fueling this sentiment. Bitcoin, the king of crypto, is currently trading around $88,420. It's been a tight range-bound 24 hours, with the price struggling to break past the psychological $90,000 barrier. This price action is a classic example of a market in consolidation, coiling up for its next big move. The 24-hour change shows a modest 1.1% gain, but the weekly picture tells a different story with a 2.3% decline. But what's holding it back? We're seeing a confluence of bearish pressures that are creating significant headwinds for the market. First, there's a significant capital flight from the crypto ecosystem. The total market cap of the top 12 stablecoins has plummeted by $2.24 billion in just 10 days. This isn't just profit-taking. This is investors cashing out to fiat, likely rotating into safe haven assets like gold and silver, which have been on a tear. Gold recently hit a record high of over $5,085, and silver is up a whopping 57% this year. This tells us that in the broader macro landscape, there's a risk of sentiment prevailing. When we see capital flowing out of stablecoins rather than just rotating within the crypto ecosystem, it's a clear sign that investors are seeking shelter elsewhere. Adding to the selling pressure is the Coinbase Premium Index, which has plunged to a one-year low. This index measures the price difference between Bitcoin on Coinbase Pro and other global exchanges. A negative premium, which we're seeing now at nearly minus 0.15%, indicates that there is stronger selling pressure from US-based investors. This is a crucial piece of the puzzle, as the US market is a major driver of institutional adoption. The fact that American investors are selling more aggressively than their global counterparts is a warning sign we cannot ignore. And speaking of institutions, we've seen 5 consecutive days of net outflows from US spot Bitcoin ETFs, totaling over $1.3 billion. This de-risking from institutional players has undoubtedly contributed to the recent price softness, with Bitcoin retracing more than 10% from its mid-January peak of nearly $98,000. The ETF flow data is particularly important because it gives us a window into how traditional finance is positioning itself in the crypto market. Then we have the Black Swan event of the week, a severe ice storm in the United States, which has knocked a significant portion of Bitcoin's mining hash rate offline. The US accounts for about a third of the global hash rate, and we saw a dramatic drop from over 1.133 exahashes per second to around 690 exahashes per second over just 2 days. This is a major disruption that the mainstream media isn't covering adequately. Mining operations like Mara and Foundry Digital were forced to shut down to avoid unsustainable electricity costs, as power grids were disrupted and prices spiked. According to crypto quant analyst Doug Frost, Mara's hash rate fell by 4 times in just 3 days compared to its monthly average. If this situation persists, we could see miners being forced to sell their Bitcoin holdings to cover their operational costs, adding even more sell-side pressure to an already fragile market. This is a scenario that could cascade quickly if the weather conditions don't improve. From a technical standpoint, the picture is equally cautious but offers some clarity. The veteran trader Peter Brandt, whose analysis I highly respect and who has been calling major market moves for decades, has pointed out that Bitcoin has broken down from a bear channel on its daily chart. He notes that Bitcoin has moved below a rising channel that was established since late December 2025. The key level to watch is $93,000. If Bitcoin can't reclaim that level, the bearish outlook remains in play, with potential downside targets of $81,833 and, in a more severe correction, even $66,883. The immediate support level to watch is $88,000, followed by $84,000. A daily close below $84,000 could accelerate the downward move significantly. However, it's not all doom and gloom. If we see a strong surge in volume and a decisive close back above the $88,000 to $90,000 range, a bullish scenario where we retest the recent highs is still on the table. A breakout above $93,000 could even set us up for a run towards $112,000, according to some technical analysts. Let me give you some additional technical context. The average RSI across the market is sitting at 47.94, which is neutral territory. This tells us the market isn't oversold or overbought. It's in a state of equilibrium. The 30-day Bitcoin and Ethereum implied volatility indices from Volmex remain near multi-month lows, indicating no signs of panic or fear, even as flows and technical charts paint a bearish picture. This low volatility environment is often the calm before the storm, and we need to be prepared for a significant move in either direction. Now, let's shift our focus to Ethereum. ETH is currently trading around $2,970, showing a bit more strength than Bitcoin with a 2.6% gain in the last 24 hours. The 24-hour trading volume for Ethereum is approximately $24.75 billion, and its market cap stands at $358.57 billion. Ethereum has bounced nicely off a key support level after the January sell-off. What's particularly interesting with Ethereum is the on-chain activity. Daily transactions on the network hit a record high of 2.9 million in mid-January, almost double the previous year's average, while average transaction fees have fallen to multi-year lows. This is a very healthy sign, indicating that the network is being used more than ever, and it's becoming more affordable to do so. This strong fundamental growth could be a key driver for Ethereum's price in the coming weeks. However, like Bitcoin, it's still facing the same macro headwinds, and the price remains 14% below its 2026 high of over $3,200 and 41% below its all-time high of $4,950 reached in August 2025. Some traders still believe that $10,000 Ethereum is on the table, but that would require a significant shift in market sentiment. What about the rest of the altcoin market? Let's dive into the data. The altcoin season index is hovering around 41, which is neutral territory. The index needs to clear 75 for a confirmed altcoin season. We're not in a full-blown alt season, but we are seeing some interesting divergences. Privacy coins like Zcash and Monero have been outperforming, up 9.6% and 3.6% respectively in the last 24 hours. Zcash is trading at $393.04 with a 24-hour volume of $577.87 million, while Monero is at $474.85 with $128.37 million in volume. This could be a flight to privacy amidst increasing regulatory scrutiny and geopolitical uncertainty. When the world gets more uncertain, some investors seek assets that offer greater privacy and autonomy. We're also seeing a resurgence in meme coins, with Pump, the native token of Pump.Fun, surging by almost 20%. This is a highly speculative corner of the market, but the volumes are undeniable. Pump.Fun's trading volume has already surpassed $10 billion in January, its highest since last June, according to DeFi Llama. And then there's Hyperliquid's native token, Hype, which is up an incredible 23.9% in the last 24 hours, driven by the massive volumes on their silver futures market. The open interest in Hype futures surged by 30% to over 57 million Hype, nearing December's record high. The decentralized exchange is said to have regained market share from rivals Asta and Lighter. Let me also highlight some other notable movers. Solana is trading at $126.20, up 2.2% in the last 24 hours with a market cap of $71.43 billion. BNB is at $891.90, up 2.2% with a market cap of $121.55 billion. XRP is showing slight weakness at $1.91, down 0.8%, but still holds a massive market cap of $115.99 billion. Dogecoin is at $0.1249, up 2.1%, continuing to show resilience in the meme coin space. Cardano is trading at $0.3558, up 1.2%, with a market cap of $13.08 billion. Bitcoin Cash is at $591.59, up 2.8%, showing strength in the Bitcoin fork category. These numbers give you a comprehensive picture of how the broader market is behaving. This brings us to the broader macroeconomic picture, which is absolutely crucial to understand. The Federal Reserve's FOMC meeting is currently underway on January 27th and 28th, and the market is holding its breath for the interest rate decision. According to CME's Fed Watch Barometer, there's only a 2.8% likelihood of a rate cut tomorrow, even by the smallest increment of 25 basis points. The consensus is that the Fed will hold rates steady, but any hawkish or dovish language in their statement could send shockwaves through the markets. A more hawkish stance could strengthen the dollar and put further pressure on risk assets like crypto. On the other hand, a dovish pivot could be the catalyst that ignites the next bull run. A recent CNBC Fed survey suggests the Fed is likely to lower rates only 2 more times in 2026, even under a potential new chair pick by President Trump. We're also keeping a close eye on the DXY, the US dollar index. Historically, a break below the 96 level on the DXY has been a very bullish signal for Bitcoin. According to analysts, the last 2 times the DXY broke below 96, Bitcoin ran from $2,000 to $20,000 within 6 months. It's currently sitting at 96.345, down 0.53% today, so we're very close to that critical level. This is one of the most important macro indicators to watch right now. And we can't ignore the geopolitical situation. President Trump's new 25% tariffs on South Korea, announced on Monday, and the ongoing tensions with the European Union over Greenland are creating a climate of uncertainty. Trump has vowed big retaliation if European countries sell U.S. assets in response to his tariff threats. In a risk-off environment, investors tend to flee to safety, which is why we're seeing the rally in gold and silver. Gold futures are up 1.23% to $5,070.12. This rotation of capital is a major headwind for the crypto market in the short term. However, it's also worth noting that in the long run, this kind of geopolitical instability and the potential for currency debasement could actually strengthen the case for Bitcoin as a non-sovereign store of value. History has shown that during times of currency wars and trade tensions, hard assets tend to outperform. Now, for the advanced insights you've been waiting for, let's dive deep into the derivatives market, because this is where the smart money operates. The 24-hour liquidation data from CoinGlass shows that $189.23 million in leverage positions were wiped out, with 82,650 traders getting liquidated. What's fascinating is that the majority of these were short positions, accounting for about 59% of the total, or $112.13 million. Long liquidations totaled $77.10 million. This indicates that many traders were betting on a further price drop and got caught off guard by the recent bounce from $86,000 to nearly $88,000. This is what we call a short squeeze, and it can often fuel a relief rally. Looking at the breakdown by time frame, the 1-hour liquidations show $22.36 million total, with shorts dominating at $21.07 million versus only $1.30 million in longs. The 4-hour data shows $44.48 million in liquidations, with $29.55 million in shorts and $14.92 million in longs. This short-heavy liquidation pattern is a bullish signal in the near term. The long/short ratio among top traders on exchanges like Binance and OKX is also showing a bullish skew. Binance BTC/USDT top trader positions show a ratio of 2.04, up 1.04%. OKX BTC longs/shorts accounts show a ratio of 2.36, up 1.29%. This means more traders are positioned for a move to the upside. This is a powerful signal, as these are the traders who are often on the right side of the market. Open interest across the derivatives market has increased by 4.11% to $134.42 billion, indicating that traders are adding positions despite the uncertainty. Bitcoin's open interest is at $59.76 billion, up 2.27% in 24 hours. Ethereum's open interest is at $39.20 billion, up an impressive 4.73%. This increase in open interest alongside price stability suggests that traders are positioning for a significant move. On the options front, we're seeing some interesting dynamics. On Deribit, BTC and ETH puts continue to trade pricier than calls, a sign of lingering concerns for a decline. According to some observers, downside protection is now a crowded trade, and calls look relatively cheap for those with a bullish market thesis. Bearish directional positioning such as put spreads and volatility bets, including straddles and strangles, cumulatively account for nearly 50% of all BTC block trades over 24 hours. In ETH's case, traders preferred the iron condor, a strategy to profit from a potential range-bound market. So, what are the potential trading scenarios for the next 24 hours? Let's outline 3 possibilities with their probabilities and specific technical triggers. Scenario 1, the bullish breakout with a 35% probability. In this scenario, we see a surge in buying volume, pushing Bitcoin decisively above the $90,000 resistance level. A confirmation of this breakout would be a 4-hour candle closing above $92,000. The technical trigger here would be the relative strength index on the 4-hour chart breaking above 60, indicating strong bullish momentum. Additional confirmation would come from the MACD crossing bullish on the daily chart. If this happens, our first target would be the recent high of around $97,850. A break above that could open the door to the $112,000 level that some analysts are calling for. For traders, a potential entry would be on a retest of the breakout level around $90,000, with a stop loss placed just below at around $87,500. The risk-reward ratio on this trade would be approximately 1 to 3. Scenario 2, the bearish breakdown with a 45% probability. This is the scenario where the selling pressure intensifies and Bitcoin breaks below the key support level of $88,000. The technical trigger to watch for here would be a daily candle closing below $87,900. This would confirm the breakdown from the bear channel that Peter Brandt identified. Additional confirmation would come from increasing volume on the breakdown and the RSI dropping below 40. The next logical support level would be $84,000. If that level fails to hold, we could see a rapid decline towards the $81,833 support. And in a more severe sell-off, the $70,000 to $66,883 range comes into play. For traders looking to short the market, a potential entry would be on a break of the $88,000 support, with a stop loss placed above the recent highs, around $91,000. The risk-reward ratio on this trade would be approximately 1 to 2.5. Scenario 3, the range-bound chop with a 20% probability. In this scenario, the market continues to trade sideways, caught between the bulls and the bears. We would see the price of Bitcoin fluctuating between $88,000 and $92,000, with low volume and no clear direction. This is often the most frustrating market to trade, and it's easy to get chopped up. The best strategy in this environment is often to wait for a clear breakout or breakdown before entering a position. For those who are more risk-averse, staying on the sidelines and preserving capital is a perfectly valid strategy. If you must trade in this environment, consider range trading strategies with tight stop losses. Before I wrap up, let me share some additional insights that could be game changers. Over half of US banks are now set to offer Bitcoin services, according to new research from River. Several major US banks have already launched BTC-related services, announced imminent plans, or restricted access to select client segments. This institutional adoption narrative is still very much alive despite the recent ETF outflows. Additionally, Standard Chartered predicts a $500 billion shift to stablecoins, which could have massive implications for the crypto ecosystem. Tether has also officially launched their Made in America USAT stablecoin as mass TradFi adoption looms. So there you have it, a comprehensive, no-nonsense analysis of the crypto market. We've covered the fundamental drivers, the technical levels, the macroeconomic factors, the derivatives data, and the potential trading scenarios for the next 24 hours. Remember, the market is a dynamic and ever-changing beast. The key to success is to stay informed, be adaptable, and manage your risk effectively. Never invest more than you can afford to lose, and always do your own research. I hope this analysis has provided you with the clarity and insights you need to navigate these choppy waters. Thank you for joining me on Boni's Life. If you found this video helpful, please hit that like button, subscribe to the channel, and ring that notification bell so you never miss an update. And I want to hear from you. What are your thoughts on the market? What are your price predictions? Do you think we're heading for a breakout or a breakdown? Let me know in the comments below. Your engagement helps this channel grow and allows me to bring you more content like this. Until next time, trade smart, stay safe, and I'll see you in the next video.